Hi guys, so we're doing the half-year results for Tortilla, and we're going to just look at the summary and Q&A because we've done another video on the previous 18 pages. So I wanted to really focus on the company's summary for the half year and a Q&A from investors. So let's hear from them.
I've always been led to believe that in the restaurant business, there are three key things that you need to be able to do to prove your business is successful and have the opportunity to grow. First one is that your existing estate continues to be successful. So your base estate, your like-for-like estate is still growing, and that still is for us, despite the difficulties. Our like-for-likes are still strong. The other thing that's really important is that when you're opening new sites, that they're all delivering on what they're expected to deliver. There's nothing worse than opening sites that struggle and fail, and you end up spending a disproportionate amount of management time trying to fix those sites, as well as potentially any other sites you have in your estate that are not performing.
And I think they've got that, a lot of their new stores are profitable within 1 month. So it's kind of an easy rollout for them. But let's hear what else they have to say.
Don't have any of that. So our new openings have been very successful, and we've taken advantage of the property market coming out of COVID, and it's proved to be a very wise move for us. And the other thing you want to be able to look at is to see a good runway and a good pipeline of potentially new sites. And that's something that is fairly unusual in this business, and we do definitely have a huge pipeline. Whether we're going to be able to take full advantage of all of that through the cash scenario, we'll have to wait and see. We'll have to see how things trade over the next 5 or 6 months, what the market looks like, what the world looks like. Every day is a different day right now. Our ambition is to continue to grow this business quickly. This business requires scale, and to get that scale, we now have an opportunity to get there slightly quicker than we originally thought.
Good.
But we will not do that by putting a load of debt into the business. We understand that that's been the downfall of many a good restaurant business, so we are very aware of the potential challenges of growing business whilst in a world of uncertainty. So
I think this is interesting. They're taking a very conservative approach. Previously in the deck, they've talked about an expected return on of capital of 30%. So if they can get debt at 6% and get a return on capital of 30%, I personally think maybe they should be considering taking on a little bit of debt, especially when they can lock in some of the lease rates for 15 years and they're getting landlord support. I think that's pretty ultra conservative, to be honest, especially as their store count is still under 100 at the time of filming this video. I think they could be going a bit quicker, but maybe they're a little bit nervous because they're still a small business, and that's it's understandable. But let's hear what else they have to say.
It's very clear for Andy and I and the rest of the board that we want to do it responsibly, but wherever possible, we want to continue to grow. We also want to always know that we're going to come out of this with a brand. If we continue to price and just keep pricing, we'll end up pricing ourselves out of the market. We don't want to do that. We think there's opportunity in price, but it will always be something we will do very carefully.
Good. That's important.
Because we're so well priced. But there's no doubt with all the challenges around, there is a realistic possibility that we will have to price again.
I think this is really important. I do think there's a price ceiling on Tortilla. It is nice food. I've been a customer since they started in the UK, but I do think there is a ceiling on these burritos. At the time of filming, we're in 2022. I think if it went above £7, they would struggle. I think $7.50 for a burrito is probably the max. I'm a high earner, by the way. I don't think I would be paying much more than $7.50 for a burrito. Of course, there is a context to this. If other restaurants and other quick QSRs, quick service restaurants, fast food restaurants up their prices, and if they're still the cheapest at $7.50, they might be able to still grow. But I think they're looking at it right, that they're conscious that the pricing is a key area for them not to increase. If it goes too high, they may risk the volume, and that will have a pressure on their hitting their return of capital goals of 30%.
So we remain highly confident in achieving our group's exciting long-term growth potential. There's no doubt that this has been a bump in the road. There's nobody more disappointed than we are. But had we been sat here now, coming out of our IPO, with the world having been in a normal place, we would have delivered what we said we would deliver. Unfortunately, external events have knocked us a little bit and possibly put us back a while. But fundamentally, this is a cracking business and remains a good business.
Yeah, I agree.
And we still have, we're still very excited to take it to the next stage. That's all from me. Thank you, Richard.
I would really like, I don't know if they've touched upon it in the previous 18 slides, because I read it before looking at this Q&A, but I don't know if anyone's going to mention international or dark kitchens and franchising. They're the three things I'm most interested to find out about.
That's great, and thank you very much indeed for your presentation this afternoon. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab that's situated on the right-hand corner of your screen. But just while the team take a few moments to review those questions that were submitted already, I would like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. Andy, Richard, we did receive a number of pre-submitted questions ahead of today's event, as well as you can see in the Q&A tab, a number of questions that have been submitted throughout today's presentation itself. So firstly, thank you to all investors for submitting their questions. And Andy, Richard, if I could just hand back to you to run through the Q&A tab and respond to those questions where it's appropriate to do so, and then I'll pick up from you at the end. Thank you.
Yes, absolutely.
Okay, I'll take the first one regarding Belfast, Northern Ireland. Yes, how does the central kitchen model work with the store on the other side of the RSC? Well, actually, not the problem at the moment. Is what was being advised by our supply chain. They already deliver out to Belfast, so we'll be able to take our product from our existing CPU over to Belfast. All the products that we produce essentially have a very good long shelf life period, so there's no issue around that. So in terms of delivery, we've not been made aware of any challenges getting to that. We've also asked if the new central kitchen is being built and how many stores does it need to support, making economic sense. Well, obviously that's not the intention to do. That's in Ireland. Would we accelerate and reach the Republic of Ireland soon? We'd like to. We think Republic of Ireland is a good opportunity. We've done some white space work on Europe, which we didn't actually talk about in the presentation.
Interesting.
We are keen to look at Europe. We've recently brought somebody onto the board called Francesca, who's an ex-CFO of young brands in Europe. So she brings with her a lot of experience of franchising and of brands in Europe. So it is something that we're looking at. And when we did our white space document some time ago, the Republic of Ireland was a very...
And that's what I was saying just a moment ago, you know, internationalization, franchising, I think is the big opportunity for them to get massive store growth. You know, they would probably have to think about it in a careful way because as I've seen with other brands, you know, in a lot of countries, you need to have a store count to get profitability. I don't know if Tortilla will be the same, but they can't, for example, go to a smaller country like Estonia or Poland or something like that and try and get profitable with, you know, 5 or 10 stores. You probably need I imagine, a bigger country like maybe Germany or something like that and try and get to a 50, 100 stores. But let's see what they say.
Very good option for us. So yes, it is definitely within our plans to look there.
So just moving on to the next question around property costs. The question was, can you give us an understanding of the changes in property costs versus 2019 and before specifically the impact on the cost of opening new restaurants for ongoing rentals thereafter? So my presentation, the slide on the presentation did cover off the rent changes in the dynamic. So we have seen our rent percentage come down on our new store opens because we've been able to get some very favourable deals from landlords. I think our view is over the next few years, most rent views you have on existing leases at the moment have been concluded at nil increase because the property market is subdued. Therefore, obviously, as pricing is going up in inflation, clearly rent stays still. It as a percentage of sales will continue to decrease. So that's our sort of ongoing thesis as to what we expect to happen in terms of the property market. I think the challenge will be we've got some good capital contributions from landlords in over the last year or so. Clearly, as landlords are more cash constrained themselves because some of them themselves are very highly leveraged, they may be less willing to part with capital contributions. But what we're seeing is healthy rent-free periods being offered instead, and things like that as kind of like lease incentives for our business.
Good.
On to the next question around HR director. Yes, we're very excited. We brought in a new people director into the business, a girl called Holly Foote, who we've been speaking to for a while. Her background is she worked in Merlin for quite some time, and she's been with Hostmore or TGI Fridays for the last couple of years. She's been involved in recruitment and a lot of employee initiatives within that business. My experience of TGI Fridays back in the days, they were a very people-focused business, and I know a lot of the work that she's been doing with them is work that we would like to be, replicated and brought across to us as well. So I'm very excited to have her on board. There is no doubt that without having a people director in the business for the last 6 months, it's been more of a challenge, more pressure being put on our operations team. So we're delighted to have her on board. We've got an L&D girl coming in as well who starts next week. So there's a big focus from us on the world of people going forward. She will be reporting directly into me, and her and I will be working very closely on her plans for the next 6 to 12 months. There's a lot to do. Outside of all the varying headwinds of utilities and food, people is the other challenge. The market is more difficult now than it's been before. We feel we offer good rates of pay. We've got some great perks and some great benefits for our employees. We're a growing business and some great career opportunities. We operate in easy to access places. We don't work into the middle of the night. So for our employees, it's a nice business to be able to work in so that they can get home at 10, 11 o'clock at night, not 2 or 3 o'clock in the morning. So there's a lot of good things about working at Tortilla, and I'm really glad to have Holly on board, spend some time focusing on those things and getting some of the culture in our business that certainly when I remember back in the day at Fridays, how important that was. So yeah, really looking forward to having her on board and working closely with her.
Okay, next up is a question, which is you are reluctant to increase your prices despite being below your competitors. You say this is helping shorten the maturity period of new stores. However, is there a better balance to be had? How are you going to sustain this? Well, clearly as a business, we aren't a charity, we're here to make profit. And there is clearly room in our pricing structure to apply further pricing. I think the art of it for us will be finding a way to minimize the amount of pricing we take and instead find opportunity by being more efficient with the use of tech and the restructuring of the supply chain, as we were kind of referring to.
Good.
So there's no doubt about it. We will have to price more, and we will try to do that in the best possible way. Because clearly we can't accept gross margin being 3% off where it needs to be. I think the shape of the P&L will change more permanently. I'm not sure we'll get back to an 80% gross margin as we were previously, but I think we can close the gap a little bit. And then with the favourable movements in the P&L around the rent, property costs, and some other elements of the P&L as well, I think we can kind of get close to a story EBITDA of 19-20% like our original business plan.
Yeah, and I think, you know, there's probably areas within the business, if they're just looking to get 3% back, I would hope that they'd be able to optimize in other ways rather than reaching towards increasing pricing as the easiest lever, because it's an expensive lever. They sacrifice customers and return customers potentially for that increase. So I don't think it's the best way of doing it. I think if the guys can look at technology and other styles of efficiencies, maybe staff turnover, maybe locations, maybe new product offerings, potentially upsells, loyalty, whatever it might be. Hopefully that can bring in that 3% rather than price increases.
There's a quick question here around pre-opening costs. That they've gone up substantially, but I think we'd have to be realistic and say in 2021, we were opening sites sort of in the middle of COVID, that we were really not doing very much with them. We were just getting the doors open. So we didn't do a lot on pre-opening, and now we are focusing a lot more on pre-opening. We are detecting that the brand site is unreasonable for pre-opening costs. We do a lot of local marketing. We do a free burrito, which we've done in all of our sites. There's just a lot more of a push around an opening for us. And if you look at this site, you look at the sales, the sites that we're opening, we're almost at maturity of sales within months of opening, as opposed to years in the past. So we do feel it's really important that we shout about ourselves when we go into some of these locations where frankly no one's heard of us. In London, we don't spend as much because we don't need to, because most people know who we are. We're going out into some of these locations like Lincoln and Leicester and Coventry, where our brand is unknown. It's very important for us to make a lot of noise.
So the next question is, are we paying too much tax for so small a profit? Interesting. Well, obviously what we're accruing in the P&L is an estimate. We are still working through, so obviously our accrual for year-to-date tax is something that we're still looking at. I would say as well, it's complicated somewhat by the question over deductibility of costs and tax charges in relation to the acquisition of Chilango. So I think the full year number for that still needs to be trued up.
We'll probably have to take this one as the last one. Your share price really reacted very badly to this announcement. Do you need to do more to manage investor expectations and to avoid such extreme reaction? Well, that's a good question. You know, and Andy and I, we are fairly new to this. We are, you know, CEO and CFO of PLC. We only IPO'd in October. These are our first interims. We are as disappointed as investors are that we were unable to deliver what we said we were going to deliver. We do feel a sense of wasn't really a lot we could do about it. So we're learning along the way here. We feel confident and comfortable that we've done what we said we were going to do and more. We will have opened 18 locations this year, which is no mean feat for a business that's only ever really done 5 or 6 in the past, and no mean feat in a very challenging, difficult market. So could we have managed expectations better? I think it was fairly obvious that with the numbers that we were putting out, that some people would get spooked by it. And unfortunately, our sector is being battered on the markets. So I guess we weren't wholly surprised. We've spent the last 4 days speaking to all of our investors, who I have to say have generally been very supportive. This is a growth investment. This was always a 5-year plan. And this hasn't derailed us. It's possibly put us back a while. But rest assured, we're doing everything we can to get to keep us on track and to continue to take advantage of the opportunities that are out there for us.
Yeah.
I think unfortunately that's our time up, as we have to head off onto another call. So
right. So I'm going to mention some of my thoughts here. I'm a long-time investor in Tortilla and customer. I've been invested since the IPO, and I've further invested before the share price slump recently. I'm talking October 2022 here at the time of recording. But I think some of my comments I'm going to make now are going to be valid, I think, for between 2 and 5 years. So yeah, it'd be good if you could let me say my piece. Let me say my piece. It's like I'm talking to a screen here, so you have to forgive me here. But anyway, Tortilla, what do I think? My 2 to 5 year thoughts on this are, the goal is what, 20 to 30% return on capital for the stores. They're trying to get to profitability in a short period of time. When they're opening stores, they're saying they can open 15 stores in the deck, but the last comment was that they can open 18. This is big for them, but it's not big in terms of the QSR space, the fast food space. So I think there's a couple of things, like if they can start to open 20, 30, 40, 50 stores a year at some point soon, then they're going to be doing very well. How does that come? I think there's a number of routes. Internationalization, yes, especially down the franchising route, 100%. Dark or cloud kitchens and acquisitions. They're already starting to do that. They did it with Chilango. Does that distract them buying a small brand, that's got 5 or 10 stores? Maybe. I think the franchising route is going to be very, very strong for them. They're not using their own capital, so it's capital light structure. And as long as they synthesize and almost processize or optimize their processes so that it can be replicable for a franchisee or a master franchisor in a country, they should be able to grow in Europe, no problem, right? So that's one thing. I think the guys are new, the board are new, the CEO and the CFO are kind of new to being a public company. I don't know if they've run public companies before. I imagine it's not easy. I haven't done it. But expectations are high when you're a growth company. And it didn't look that good, this release, the drop in at EBITDA. It seems like a lot of it is based on some tax potentially, and some other stuff, like they were relying on revenues from like R&D credits and government and whatnot. But anyway, the main story for me is that it looks like they're going to be earning somewhere between 2 and 2.5 million every half quarter, right? So every half year, half quarter. What am I talking about? It is about midnight here, folks. It's 1:45, and I have recorded a couple of videos today, including some at 5 a.m. So it's been a long day. Apologies. But from what I remember, I think they're on a path to making 2.5 million in EBITDA every half year, which I think within a year or two, they're going to be making 5 million a year, right? If their store count grows by 20 to 25 stores a year, that could go up to 6. And then with franchising, I wouldn't be surprised if within 2, 3, maybe 4 years, they're hitting 10 million of EBITDA a year. They have a favorable environment at the moment with long leases and rent kind of offerings, which seem to be quite good. So I think now would be for the time for them to try to go for growth. The challenges are they're a small business and it seems like they've got some experience, but not a huge amount of experience. They're bringing on some people from Yum and TGI Fridays. I think they should try and bring on someone from something like Domino's Pizza UK, because that has gone through a similar trajectory, going from kind of 50 stores to 1,200 stores in 15 years is no mean feat. And I think they should be looking at that kind of growth. Is it 1,500? It might be 1,200, but you get the idea. I think that, for the investors that are selling, I'm not sure that, I think that's a short-term view. I think that Tortilla over the next 5 years is going to do very well. If it can reach 10 million in profit within 5 years, who's to say it won't be valued at 10x or 20x or even 30x earnings once the stock markets recover? They might be recovered in 5 years. If it's at 20x, it's 200 million. It's valued at 42 million at the time of recording. That's nearly 5x return right there. right? Domino's Pizza, when it was growing very rapidly, it was sometimes valued at 35x price to earnings ratio. Sometimes I think it might have hit 40. And as a young, naive investor, I would sell when it hit 40, thinking I'd be able to buy it cheaper. Earnings would come out and the stock price always went up. And that could happen with Tortilla. We're in a blip at the moment because they posted some bad earnings, but the environment is good. And the team, I think, is a good enough team to grow the store count by 25 to 30 stores a year. And you never know, in a year or two, I think they're going to have the team, the talent, and the resources to ramp up, get to 40 stores a year, maybe. And then, it's off to the races, 50 stores, 60 stores, 80 stores, 100 stores. And, it could be quite a big company. And why shouldn't it be? They don't have strong competitors. There's a lot of white space. They're looking at a return on capital of 20 to 30% per store. If they can get debt for 6-7%, I don't know why they aren't taking some on. I know it's stressful, but they're in business. Business is stress, but there might be 2 years of stress. But if they can do what they're doing, I would say that debt could be rocket fuel. If it's not debt, franchising. Franchising is free. Is a free way to grow your store count. Cloud kitchens are cheaper, potentially. So there's a lot of routes to revenue, if you like. And they might want to do all of these options possibly, but I do think franchising and international, going international, they should be looked at very carefully, and I really think they should be doing it. The faster they go to market with franchising, the faster it can grow. We've seen it with Cake Box, we've seen it with Domino's Pizza, we've seen it with McDonald's. Franchising is a win once you've worked out a product offering that is working in the market, which Tortilla have clearly. Then they can consider and should consider strongly franchising. That's my piece. I'm not going to sell my shares. I'm going to buy more. I'm going to try to buy more. I'm buying a lot of startups, obviously. If anyone that watches my channel will see, I'm investing at least the minimums in a lot of these startups, robotic companies, artificial intelligence companies. And often the minimum investments are $1,000 a time. At time of recording, FX rates for the dollar and the pound are very, very close. It's often over £1,000 when you look at fees, and there's quite a few that are happening at the moment. So I don't know how much I can afford to invest in Tortilla shares, but I am going to invest in them more, and I would love to be investing a lot more. Unfortunately, I put in quite a bit at the start, believing in the growth story, and I still believe in it, but I think now is a brilliant time to buy shares. It's not advice. I'm not a financial advisor. I'm just doing it from a logical perspective. They're valued at, 40 million or something. And I honestly believe that, within 3 to 4 years, they're going to be making 5 to 10 million a year. And it is crazy for a company to be valued at 40 million if it's going to make 10 million a year. It's just, it's not going to happen. It's going to at least go to 100 million would be my expectation, because if it's making 10 mil, 100 million is only 10x. For a growth company, that would still be incredibly cheap. That's my opinion. Guys, if you like this video, how can you support the channel? First, invest in the like button. Make it blue. Make it like the Facebook blue that I work for. Actually, I work for WhatsApp, which is not blue, but anyway. If you could, the way to help me would be to smash the like button. Consider hitting the subscribe button. As you can tell, my videos, they're not very stylish. I put substance over style. Hope that you are getting value from these videos, the analysis I do, insight potentially, and some of the questions I throw out for myself and maybe the companies themselves. Let me know if you've got any questions, comments, if you want me to make any videos. Comment in the description box below. Comment in the comment section below, and there'll be some links to support me in the description. Actually, this is a bit, sorry guys, that's a little bit, is that a bit clearer? Hopefully it's a bit clearer. There'll be some links to support me in the description. Also, if you're interested in any other videos, there'll be some playlists and some videos that are going to be recommended on investing in startups or indeed in the restaurant industry, etc. Guys, remember that knowledge is power, especially the right kind of knowledge. Remember, the more you learn, the more you earn. I'll see you guys in the next upcoming video. Take care. Cheers.